Welcome to Morning Mortgages, your source for news on mortgages. Today we will explore the alarming 6% mortgage rate, which has not been seen since 2008. And for those of you who are interested in purchasing a house, we will discuss whether to buy now or wait. Stick around to learn more. Imagine that you are a potential homebuyer investigating the idea of purchasing a property. You turn on the television and hear reports of a 6% mortgage rate. You wonder, how terrible is it? And should I wait to buy a home? To address this, let's examine the current mortgage news. First of all, mortgage rates did surpass 6% for the first time since 2008 yesterday, after a severe sell-off in the mortgage securities market, a situation that might further dampen the housing industry. Tuesday, the average 30-year fixed mortgage rate increased 10 basis points to 6.28%, according to Mortgage News Daily. That follows Monday's 33 basis points increase. A week earlier, the rate was at 5.55%. The housing market has seen a severe reversal due to the rising interest rates. Demand for mortgages has fallen. 6 consecutive months have seen a decline in home sales, according to the National Association of Realtors. Rising interest rates have so far had no effect on the red-hot housing market, which has been powered by historically high 2020-driven demand and record low supply. Similar events occurred in 2013 when investors drove up Treasury rates in response to the Federal Reserve Board's announcement that it would reduce its bond purchases. The difference back then was the board felt it was time to begin unwinding some of the loose policies implemented following the financial crisis. This time, the board is in a state of panic about runaway inflation. During 2020, mortgage rates reached more than a dozen record lows as the Federal Reserve Board pumped money into the mortgage-backed bonds. It recently discontinued its support and is likely to shortly begin selling its assets. What effect do interest rates have on homebuyers? According to the conclusions of a recent study conducted by LendingTree, the recent spike in mortgage rates in the United States may increase the average monthly payment for a mortgage by hundreds of dollars, adding up to over $150,000 in extra costs over the lifetime of a typical loan. In order to compute the monthly payments, LendingTree reviewed the offers for 30-year fixed-rate mortgages made to more than 570,000 unique consumers on its website. In addition, it used the annual percentage rate, also known as the APR, which takes into account the costs of borrowing and any other relevant fees, and is often higher than the interest rate used to calculate a loan. Comparing the average monthly payments on a 30-year fixed-rate mortgage across the nation in January, when the average rate was 3.79%, to April, when the average rate was 5.25%. They discovered that the states with the highest home prices had new borrowers who may see larger increases in expenses. This was the case in the states with the highest housing costs. For instance, California homebuyers paid an extra $407 per month in taxes and fees. This translated to about $150,000 in increased mortgage payments over the course of a 30-year mortgage. In Washington, monthly payments increased by $357, while in Massachusetts, they increased by $337. According to the study, these extra monthly costs would have costed an average of $120,000 to $130,000 over the life of a 30-year loan. In addition, according to the poll results, Ohio, West Virginia, and Kentucky had the fewest average yearly increases, all around $200. This resulted in an increased expense of nearly $70,000 over 30 years. As we can see, the impact of rising mortgage interest rates is heavily dependent on the property market in question. Let's now consider housing affordability and how it may influence your choice to purchase a property. The National Association of Realtors article examined the decline in house affordability in relation to rising mortgage rates. According to the association's Home Affordability Index, the national level of housing affordability decreased in April compared to the last month. The monthly mortgage payment grew by 14.5% compared to the last month, but the median household income increased by just 0.7%. In April, affordability decreased in comparison to a year before, as the monthly mortgage payment increased by 45% and the median household income increased by 2.5%. In April of this year, the effective 30-year fixed mortgage rate was 5.05% compared to the 3.11% a year before, while the median sales price of existing homes grew 14.8% annually. In other words, mortgage rates rose in April and housing affordability declined. The national and regional indices were all over 100 in April 2022, with the exception of the West, where the index was 88.4. A value greater than 100 indicates that a family with the median income could afford a property priced at the median price. The West remained the least affordable area, with an index of 88.4. This is the second month in a row in which the West index was below 100. The South ranked second in terms of affordability with an index of 109.8. The Northeast was the third least affordable area, with an affordability index of 117.6. The Midwest was the most inexpensive area, with an affordability index of 150. Again, we see that home affordability is heavily dependent on the market in question. So, is it a good idea to purchase a home now? Remember that this is not financial advice, and it is only an opinion. Please do your own research and consider your financial situation before making any long-term decision. Although we have seen that the effect of interest rates and home affordability are dependent on the area where you are looking to purchase, it is difficult to ignore the overall effect of interest rates and the high volatility we are experiencing. But where do we go from here? This question is difficult to answer at the moment. Today, at 2 p.m., the Federal Reserve Board is set to make a decision about interest rates, which may have a significant impact on the market. Depending on the verdict, there might be a large amount of volatility this afternoon beginning at 2 p.m. Currently, homebuyers have the worst of both worlds, pricey houses and high interest rates. Therefore, if you are presently in a secure, inexpensive housing position, it may be prudent to postpone your purchase until the market stabilizes. However, if you are in a position to buy because of a relocation or your current living situation, it is not impossible to do so right now. It simply means that you should be aware of your options when looking to buy a home. It is difficult to predict what will happen with interest rates in the future, but depending on your circumstances, an adjustable rate mortgage may be a good option. You could get a low rate now and refinance later after the fixed rate period expires. There are numerous mortgage options available to you even in these difficult times. Have a fantastic rest of your day, and I'll see you next time.